And welcome everyone to Global Business here on CGTN. I'm Michael Wong in Beijing. The headlines we're tracking for you at this hour. The CPC Central Committee Political Bureau maps out proactive measures to ensure China's high-quality development. China's July manufacturing PMI slipped due to a prior high base, but activity over in the high-tech sector seeing robust expansion once more, underscoring China's continued industrial upgrading. And a joint letter signed by more than 200 U.S. tech companies urges Washington to avoid premature restrictions when it comes to open-weight AI models. Right, let's start with the equity markets. A quick look at the Chinese mainland markets, where equities did close higher on this Friday. The Shanghai Composite Index gaining by 0.7% on the day, while the Shenzhen Component rallying 2.2% on the day. All right, now a look at how regional markets performed and how Wall Street closed out overnight. Well, first up, China has announced it will hold the fifth plenary session of the 20th Communist Party of China Central Committee right here in Beijing in October. The decision was made at a CPC Central Committee Political Bureau meeting. The meeting also analyzed and studied the current economic situation and made arrangements for economic work in the second half of this year. General Secretary of the CPC Central Committee, Xi Jinping, chaired the meeting.
The meeting noted positive economic momentum of the nation, with new drivers emerging and structure improving, while acknowledging difficulties and challenges. It called for confidence and proactive steps toward high-quality development. It urged better coordination of domestic and international imperatives, balancing development and security, deepening reform and opening up, and accelerating the shift from old to new growth drivers. They also called for a more proactive fiscal policy and appropriately accommodative monetary policy, boosting domestic demand, optimizing supply, improving people's livelihoods, and striving for a strong start to the 15th five-year plan period. On macro policy, the meeting urged to accelerate the disbursement of fiscal funds and bonds proceeds with flexible adjustments to monetary policy tools. To expand domestic demand, the meeting emphasized deepening the AI Plus initiative, improving AI governance, building new pillar industries, and upgrading traditional industries. The meeting highlighted a fair and orderly market competition environment, formulating regulations for a unified national market, deepening reforms of state-owned enterprises, and optimizing the environment for the private sector. It also stressed expanding international trade cooperation, promoting balanced trade, and actively attracting foreign investment. On agriculture, the meeting urged stable income growth for farmers and solid production for a full-year grain harvest. It called for multiple measures to strengthen Social Security, especially protecting the rights of workers in flexible and new forms of employment. The meeting also stressed ecological protection and advancing carbon peaking and carbon neutrality. The meeting emphasized stabilizing the real estate market, pushing reforms and risk resolution for small and medium-sized financial institutions, and enhancing capital market resilience and confidence. It also called for preventing major accidents and stepping up inspections and management of disaster and safety hazards.
And the Communist Party of China Central Committee has held a symposium with non-CPC personages to seek opinions and suggestions on the country's current economic situation and economic work for the second half of the year. General Secretary of the CPC Central Committee, Xi Jinping, presided over the symposium and delivered an important speech on July 24th. President Xi called for stronger policy support to sustain economic recovery and ensure a solid start to the 15th five-year plan period.
At the meeting, General Secretary Xi Jinping heard opinions and suggestions from leaders of the non-CPC parties, the All China Federation of Industry and Commerce, and representatives of entities without party affiliation on the current economic situation and economic work for the second half of the year. Xi stressed that efforts should adhere to the principle of pursuing progress while ensuring stability, apply the new development philosophy, accelerate the fostering of a new development paradigm, and better coordinate development and security. He called for implementing a more proactive fiscal policy and appropriately accommodative monetary policy, making full use of existing measures while introducing practical and effective incremental policies in a timely manner. She also urged stronger counter-cyclical adjustments, greater efforts to expand domestic demand and optimize supply, improve people's well-being, enhance development momentum, stimulate social vitality, and promote sustained economic growth toward higher quality and greater efficiency, striving for a good start to the 15th five-year plan period. Li Qiang, member of the Standing Committee of the Political Bureau of the CPC Central Committee, briefed participants on the country's economic performance in the first half of the year and outlined considerations for economic work in the months ahead. Participants expressed support for the CPC Central Committee's assessment of the current economic situation and offered suggestions on fostering new growth drivers, promoting deeper integration between technological and industrial innovation, expanding consumption and effective investment, advancing high-standard opening up, strengthening basic research, stabilizing employment, and improving standards for the intelligent economy. She said China's economy has withstood pressure and continued to improve in quality despite risks and challenges, at home and abroad, demonstrating strong resilience and vitality. While acknowledging remaining challenges, he called for greater efforts to enhance the effectiveness of macroeconomic policies, tap the potential of domestic demand, deepen reform, expand high-standard opening up, improve people's well-being, and continue diffusing risks in key areas. She also encouraged the non-CPC parties, the All China Federation of Industry and Commerce, and personages without party affiliation to continue offering targeted policy recommendations and help build broad support for high-quality development.
All right, let's get more on the growth drivers of the Chinese economy and the latest signals from the meeting of the Political Bureau of the CPC Central Committee. We're joined now by Liu Zhiqin, a senior fellow at Renmin University's Chongyang Institute for Financial Studies. Mr. Liu, welcome to the program as always. So compared with the April Political Bureau meeting, this latest meeting shifts the focus from stabilizing demand to improving its quality and expanding its scale. How do you interpret this shift in China's domestic demand strategy?
I think this meeting has sent a very important signal to the market, especially to the market in domestic and also for external market. We know China are facing the pressure from some countries from external market, from the technical embargo or technical sanction, even from some special policies that to prevent China's from its developing AI and the latest technology. So how to expand and strengthen China's domestic demand is the key solution for future development in China. That's why this meeting emphasizes this focusing in the rest of the time of this year to stabilizing the market and also at the same time that to advancing the consumption, especially to upgrade and high level of quality offering to the market, because the people's living standards has been well managed and improved, but still they have a very big space and room to get improved. So that's why this meeting emphasizes this more efforts in different areas for the financial and other policy driving. So in this section that we can have more opportunities to upgrade our development in the time to come.
Yeah, and speaking of upgrading development, Mr. Liu, of course, innovation and technology is going to play a very big part in that. The latest Political Bureau meeting also placing greater emphasis when it comes to basic scientific research, the AI Plus initiative, and future industries. AI Plus meaning AI plus, let's say, healthcare, AI plus e-commerce, etc. How could these innovation policies, you think, create new growth drivers and further reshape China's modern industrial system?
Actually, from this focusing on the shifting of this central policies making, we can see that how the government central government laid great importance to upgrade and improve the living standard of the people and the quality of our modernization, especially in this new area. So we find that, especially in the new medical care and also in other AI technologies, the green technology also, not only for the environmental improving, but also for the living standard is very dependent on this progress. So in this way, we find that all these policies have been become more dynamic and resilient. We see that the external market, especially all over the world, are paying greatest importance to the 3 points: AI technology, green technology, or robotic and other medical care and medical science and technologies. So China has a big market, has a huge demand in these 3 areas. So we have to pay great attention to concentrate, to make more contributions, not only for China's domestic market, but also for international market, for international demand.
Yeah, let me ask you about some new growth drivers here in China, Mr. Liu, because there is something in China called the New 3. And that specifically refers to electric vehicles. It refers to solar panels and also new energy batteries like lithium-ion batteries. But now there's a new set of growth engines powering China's growth. It's called the New 3, which are AI, robotics, and innovative pharmaceuticals. How important are these sectors in terms of driving China's next stage of growth?
That's a very important question, because we know in the past 30 years, China has been well developed in 3 different steps. One is that China developed from the old 3. And the second is the new 3, the products or scientists. Now we have new 3. All this latest development has been already included in this new 3 technologies and development. This is not only a project related, but also related to the latest science and also from high-tech AI, for instance, robots, and also medical care. All this closely linked and related with the people's life. And especially when we are under pressure and also under uncertainties from the external market, all these 3 points are the lifeline of our policy. So that's why we laid great attention and effort for the basic research. This is very important. Also, we have more opening up policies and take more measures to stabilize our domestic market and at the same time enlarge our connections with the outside. That's why we have always CIIE, for instance, export. So in this way that China has more opportunities and chances to deal with all uncertainties and the challenges we are facing. And we provided more benefits to the rest of the world. This is our technology and also our major policy purpose, that to make the whole world developed in the right direction.
Okay, Mr. Liu, we're going to leave it there. Many thanks, as always. That's Liu Zhiqian, Senior Fellow at Renmin University's Chongyang Institute for Financial Studies. Okay, I want to turn now to China-U.S. relations, where Chinese Vice Premier He Lifeng, also China's lead person for China-U.S. economic and trade affairs, has spoken with U.S. Treasury Secretary Scott Bessent and U.S. Trade Representative Jamieson Greer via video. Now, the discussions on Thursday were characterized as candid. They were in-depth and also constructive. Now, on the agenda was implementing the important consensus reached by the 2 heads of state when they met right here in Beijing back in May. Both sides also discussed ways to stabilize ties, boost cooperation, and resolve issues. Now, China expressed serious concerns over the United States' recent economic and trade restrictions. They also agreed to keep using the current consultation mechanism to help build a constructive relationship of strategic stability. All right, we're going to take a short break. Still to come here on Global Business. China's July manufacturing PMI slipped due to a prior high base, but activity in the high-tech sector saw robust expansion, underscoring China's continued industrial upgrading.
A vast land of 1.4 billion people. The world's second largest economy. Home to stories of the unexpected, the unimaginable, the breathtaking. Stories that touch the soul. Feel the speed, the passion. Enjoy spectacular natural and cultural landscapes. Feel the thrill of cutting-edge innovations. Discovering China. Global Biz. China Travel. We present a China never seen before. 24/7 at your fingertips.
Well, China's factory activity moderated in July with the Manufacturing Purchasing Managers Index falling to 49.2, its lowest level in 3 months, down from 50.3 in June. Now, that decline was mainly due to a high comparison base from earlier rapid growth in the onset of production slack seasons in certain industries. In contrast, high-tech manufacturing continued to expand, posting a reading of 53.3 and reinforcing its role as a key driver of industrial upgrading. Meanwhile, the services sector softened to 49, although summer holidays did provide a boost to air transport, accommodation, and cultural entertainment. All right, let's get a closer look now at how the equity markets performed here on the Chinese mainland, Hong Kong, and Tokyo. Tim Pope joins us now from Shanghai. So, Tim, it has been a wild couple of days for the Chinese mainland stock markets. How is the dust settling at the end of the trading week?
It has definitely been a wild week, Michael. The latest US technology earnings have made Chinese AI stocks whipsaw over the past couple of sessions. Before we get into that, though, as far as how the dust is settling, the Shanghai Composite Index added 0.7% today. The Shenzhen component rose 2.2%, and the Chinext gained 3%. And those numbers just scream technology rebound. Yesterday's sell-off was absolutely brutal, after we saw the results from Meta and some other US technology companies reviving concerns about hyperscalers' enormous AI spending. The worry is that they may be investing too much too quickly without generating returns fast enough to really justify that. And that punished both ends of the market. It hit the US tech giants because of the scale of their spending, and it hit their suppliers here in China because it cast doubt over future demand. But then we got the results from Azure, Microsoft's cloud computing division, and the market grabbed at those like a lifebelt. Azure's revenue grew faster than expected. Demand is still exceeding Microsoft's available computing capacity, and the company says its spending will continue. Now, that is fantastic news for Chinese optical transceiver companies, data equipment makers, semiconductor firms, memory chip producers, basically the entire AI supply chain. And it's those shares that are currently underpinning gains for the Chinese mainland markets. The rebound also came despite some of the slightly disappointing economic data, the headline data anyway that you've just been referring to, the manufacturing PMI unexpectedly slipping back into contraction territory. The other big event of the week was, of course, the Politburo's July economic meeting. We got the readout late yesterday, but the market seemed to have taken note of that without really trading on it. If the Politburo were driving today's rally, you would expect to see broader gains across domestically exposed sectors, property, consumer shares, brokerages, perhaps some of the large state-owned companies as well. The language on capital market reform was actually one of the more notable changes in tone in the Politburo readout, but even that didn't produce a really broad-based financial sector rally. Instead, we saw the Shanghai Composite left somewhat in the dust today because investors spent today rushing back into the technology shares that they abandoned yesterday, Michael.
Right. So, Tim, it was a risk-on day for Chinese mainland equities, and it looked like a similar picture over in Hong Kong and Tokyo this Friday. What have you been following in those two markets?
Yeah, the regional picture was pretty similar. There was a strong reaction to the Azure financial report. It was interesting to see Hong Kong trade more cautiously on the news than other Asian markets. But if you're looking at gains across the region today, it was South Korea first and the rest nowhere. The Kospi 200 added 20%, largely thanks to a recovery for its massive memory chip companies. The Hang Seng ended just slightly higher. The Hang Seng Tech Index rose about 0.5%. So it was participating in the rally, but at the back of the field. Optical transceiver maker Zhongji InnoLight, they might just want to pretend that their first day of trade never happened. Its market debut yesterday fell 2% below the listing price, even though that listing was in very high demand. But today was completely different. The stock was up more than 20% at the intraday high, although it closed only 7.1% higher. The other big mover of the day was Xiaomi, the maker of smartphones, EVs, and just about everything else you can think of on the consumer side. It was down 7.3% following the launch of 2 new EVs last night. It seems to be less a market reaction to the cars themselves than profit-taking after a big pre-launch rally. And while Hong Kong was lagging behind a little bit today, Tokyo's Nikkei 225 was up among the leaders, adding 4%, again on that Microsoft news. A lot of the Nikkei's heavyweights are exposed to the US AI and hyperscaling build-out. So we saw Advantest up 16% and the tech investor SoftBank adding 14%. On the other end of things, however, on the equity market, it wasn't doing quite so well. Automakers fell after reports of a currency intervention by the Japanese government to prop up the yen, which has been sitting near a 40-year low. And also the Bank of Japan surprised absolutely nobody by keeping interest rates unchanged and saying that it will be watching inflation to make sure things don't get too hot, Michael.
All right, Tim, many thanks for that report. As always, a Timpo for us in Shanghai. Well, the U.S. saw weaker economic growth in the second quarter, pulled down by less government spending and a dip in inventories. But consumer spending continued at a healthy pace. Our Karina Mitchell has more.
Okay, so let's talk about GDP, gross domestic product. We saw a rise of 1.5% for the advance estimate of the second quarter, according to the Labor Department. That's a little bit weaker than the 1.8% that analysts had been hoping for. Definitely not as robust as the 2.1% we saw in the previous quarter. So some of that weakening came in 2 major areas. One of them was we saw a decline in U.S. government spending. That saw a drop of about 0.3%, and then inventories lower as well by about 0.7%. But there were other key metric areas that actually saw some strengthening. One of them was consumer spending. We were very worried about that in the last quarter because the rise was very meager, up by just 0.4%. This time round, no worries at all. We saw the rise came in at 2.1%. That's a very healthy number. Also, we saw final sales to domestic purchasers. That saw a very nice rise as well, up by 3.9%. Exports also higher by 0.5%. So what does this mean about the U.S. economy overall? That it's quite stable. It is humming along, and that's despite some big challenges that it has been facing. One of them, of course, inflation, higher prices for goods and services, this ongoing war with Iran that has caused so many supply chain disruptions as well. But consumption still is quite healthy, and business investment also quite stable, particularly when it comes to the AI trade. We see lots of money being invested into those platforms. All right, let's move on to the markets and take a look at Wall Street. I do just want to touch on the bond market. It's not something that we talk about a lot or very often, but the 30-year yield up close to the highest level since 2007. That is because the U.S. Federal Reserve, our central bank, declined to raise interest rates after its 2-day policy meeting wrapped up just a day ago. On to the benchmarks, it was a lot of green across the screen. The Dow was up by 1.2%. The Nasdaq was a big winner, up by 2.8%, snapping a 6-day losing streak, helped along by recovery in chip stocks. Microsoft also performing quite well. After the bell, Apple also a nice revenue beat, and then the S&P up by 1.7%. Quick look ahead to the Friday session. We will get more earnings, and we'll wrap up what has been an incredibly busy week with the majority of earnings that have come in, including big tech and economic data as well. So we'll wrap it all up and put it in a bow nicely for you all to understand. Karina Mitchell, CGTN, New York.
Meanwhile, Japanese automaker Toyota is closing its factory over in Tijuana, a city on the U.S.-Mexico border, as uncertainty over trade policy between the two countries intensifies. But analysts do say other investments have flowed into the city, giving it a new lease on life and a chance to reinvent itself. Our Alistair Baverstock has more.
After more than 2 decades of operations at the US-Mexico border, Japanese car brand Toyota will be winding down production at its factory in Tijuana. The announcement came just days after the US Trump administration confirmed it would not renew the current North American Free Trade Pact, USMCA, and sent shockwaves through the country.
President Trump himself has linked the decision to the tariffs his administration imposed on Mexico and other countries involved in the auto industry. Toyota, however, says the move is part of a global business review. We are in talks with Toyota to ensure the best possible outcome for Mexican workers.
Toyota's decision could affect some 2,800 jobs in Tijuana as production is gradually transferred to a new $3.6 billion plant in San Antonio, Texas by 2030. For 2 decades, Toyota's Tijuana plant symbolized North America's deeply integrated supply chains. Its relocation won't end manufacturing in Mexico, but it does offer an early indication of how companies are beginning to redraw their production maps amid the uncertain future of USMCA. Toyota is not leaving Mexico altogether. The company will continue operating the factory it opened in Guanajuato state in 2019 in the Bajío region, Mexico's automotive manufacturing heartland. Mauricio Monroy advises international manufacturers investing along the US-Mexico border.
Tijuana was never really the natural home for automotive manufacturing. Logistics are more difficult and there aren't the same supplier networks. The Bajío region was built for that industry.
But Monroy says Toyota's move should not be mistaken for a broader industrial retreat. Investment continues to arrive in northwest Mexico, particularly from Chinese manufacturers.
Siguen llegando operaciones y curiosamente son operaciones de China.
Investment is still coming to Tijuana, and much of it is from China. As some companies leave, Chinese firms see an opportunity to buy or lease industrial space at lower cost, particularly for electronics manufacturing, such as televisions.
Toyota's departure may be a setback for Tijuana's automotive sector, but with investment still flowing into other industries, analysts say the city is likely to evolve rather than decline. Alistair Baverstock, CGTN, Mexico City.
All right, and other headlines we're tracking at this hour. The Republic of Korea will launch a $14 billion sovereign wealth fund next year, targeting long-term investments when it comes to cutting-edge industries. The Finance Ministry said Friday the fund will operate through the Korea Investment Corporation's global network with a focus on long-term horizons. Oil prices fell on Friday but are still on track for nearly 20% gain for the month. Uncertainties from Middle East tensions and oil inventory shifts have disrupted global supply outlooks. Meanwhile, Saudi Arabia is seeking to build a coalition with support from 14 nations in order to protect key energy waterways from Houthi threats. And in Australia, the producer price index there for the second quarter of 2026 rose 3.6% year on year. That was all driven by surging fuel prices linked to supply disruptions in the Strait of Hormuz amid ongoing tensions in the Middle East. That marks the steepest quarterly increase since late 2023. All right, and up next here on Global Business. A joint letter signed by more than 200 U.S. tech companies urges Washington to avoid premature restrictions when it comes to open-weight AI models.
The world economy as we know it is about to change. Global business reports highlight emerging markets, developing countries, and dynamic sectors worldwide. We feature top analysts and newsmakers to provide perspectives on every facet of business. From an on-the-ground perspective, we provide you with balanced and objective assessments. Fast, sharp, and insightful. Global Business. Only on CGTN.
Well, China's AI development accelerated in the first half of this year, achieving multiple breakthroughs when it comes to the value chain. At a news conference today, the National Development and Reform Commission says China's AI computing power increased almost twofold compared to a year ago by the end of June. Chinese AI startups such as DeepSeek and Moonshot have all launched, of course, open-source large language models with trillion-level parameters. Global downloads of China's AI models exceeded some 10 billion. AI developers have also sped up the adoption to homemade hardware. The NDRC, that's China's top economic planner, saying AI-related industries maintain growth above 30%, injecting sustained momentum into China's economy. Meanwhile, global tech heavyweights, including NVIDIA, Microsoft, and Meta, published a joint open letter last Friday titled Open Weights and American AI Leadership. OpenAI, Google, and AMD later added their support. The letter argues that the U.S. can only maintain its global AI lead by building a strong, open ecosystem that permeates into every sector. According to that letter, open weights expand access to the AI economy, enabling startups, established businesses, universities, and public institutions to build on advanced models. It also says open weights strengthen competition, and competition ensures the gains of AI are broadly shared, rather than concentrated in a few hands. The letter further notes that openness gives customers greater control and may be one of the most important pathways to AI safety and security. It also urges Washington to adopt targeted legal frameworks rather than broad bans when addressing legitimate security concerns. Well, the United States has recently rolled out a series of measures that could carry significant implications for global AI collaboration and competition. My colleague He Jingyi is here with us in the studio to walk us through the details. Jingyi, what more can you share with us?
Yes, Michael. Now, as you can see, the U.S. is taking a three-part approach to AI governance, focusing on who gets access to computing power, how AI models are used, and who joins its technology network. And the first, American AI Exports Program, established under a White House executive order last year, it aims to expand the global use of U.S. full-stack AI technologies. It covers AI models, applications, computing infrastructure, and advanced chips. At the same time, Washington has tightened controls on advanced chips and the related technologies. The U.S. says the measures are needed for national security reasons. Critics say this creates a two-track system: easier access for partners, but tighter restrictions for others. And second, the debate on adversarial distillation. Distillation itself is a common AI training technique, where a smaller student model learns from a more powerful teacher model. But U.S. policymakers introduced the term adversarial distillation. It describes the unauthorized extraction or transfer of advanced AI capabilities. Critics argue that the line between research and misuse remains unclear, and thus cross-border cooperation could face more scrutiny. And third, PAC Silica declarations. The U.S. launched the initiative in 2025. Its goal is to strengthen cooperation on technology supply chains. It focuses on AI, semiconductors, critical minerals, and advanced manufacturing. Its initial signatories included the U.S., Japan, the Republic of Korea, the UK, Australia, Israel, and Singapore. Some analysts see it as an effort to build a U.S.-led technology partnership network. These measures actually have sparked a debate over a potential double standard in AI governance. Critics warn that it could slow efforts towards a more open, inclusive, and collaborative AI development. That's all from me. Back to you, Michael.
All right, Jingyi, many thanks for that breakdown and that report. Meanwhile, the European Commission announced Thursday it is making 10 billion euros in public funding available when it comes to the construction of 7 AI gigafactories across the 27-nation bloc. Here's more.
AI development accelerates. Access to raw-scale computing power within AI gigafactories has become a strategic necessity for Europe. EU leaders are pushing to establish tech sovereignty as quickly as possible, aiming to reduce reliance on technology from foreign providers.
Today, we're indeed launching the call to build up to 7 AI gigafactories across Europe. This is simply one of the largest public-private partnerships, unlocking some 30 billion euro of investments. Now, why does Europe need this? Because Europe wants to become the first AI continent. These AI gigafactories will provide the necessary computing power to make this possible.
Under the new plan, each gigafactory will be equipped with at least 100,000 cutting-edge AI chips, making them roughly 4 times more powerful than the data centers currently operating in the EU. Once all 7 are up and running, the block's total computing power will more than double.
So AI is indeed reaching an important crossroads. Around the world, governments are investing heavily in AI while companies debate whether the most important and advanced models should be open or closed. Let's get more on that and bring in Dr. Zhou Mi, a senior research fellow at the Chinese Academy of International Trade and Economic Cooperation. Dr. Zhou, so not every U.S. AI company fully supports open source models. Anthropic, for example, did publicly express support for open weight, but declined to sign that NVIDIA CEO Jensen Huang letter defending open source. Anthropic, of course, a major frontier AI lab. How do you interpret the company's position?
Well, we know Anthropic is a very leading company in the United States in the AI age. And I think that the reason why they want to support that is because they have some competition or rivalry with another giants like the ChatGPT. So they have a lot of arguments about how could a company, AI company, could deal with its data and abilities. So they want to try to compete with the ChatGPT in this way. But when they are talking about the real action, I think that Anthropic is thinking it another way. They want to try to keep its advantages and competitiveness in the global market. So when they are really wanted to do something, I think that they are having some hesitate to do that. So it's not just from the originates as an open source company. So when they are trying to do that, I think they have to take it for more considerations.
Right. So, Dr. Zhou, of course, many tech companies do indeed support open source AI. The U.S. government seems to have a more cautious approach when it comes to open source. Could this joint letter by U.S. tech giants, you think, on open source AI have any influence on future U.S. AI policy?
I think it's maybe possible, but not that easy because the U.S. government has a lot of cautious in dealing with the AI. And I think it's not just for the U.S., but also for all the governments, because the AI is a very leading and, cutting edge technology. When they are trying to define the boundaries, many governments are very cautious to trying to make it, applied for the applications in the market, while at the same time to keep it in the security. So I think the U.S. government are very cautious on the hardwares, like the chips making. So when they're talking about the AI, the large language model, they may be more cautious in trying to be more open.
Right. Let's talk about China, Dr. Zhou, because China's confidence in open source AI has been fueled by the rapid development of its own LLMs and the faster application of AI across the real economy. What comparative advantages does China have when it comes to developing AI as the competition to diffuse AI around the world intensifies?
Well, I mean, the world needs the AI. It's not just because that's some of these developed economies need that. All the developing economies and at least the developed economies also need that. So when we're talking about the open source, it's kind of a philosophy to try to share our technology with all the related stakeholders. We want to open our source and trying to help these companies and all the different stakeholders to enhance their abilities in the AI-driven economy. I think that is a kind of be welcomed strategies, and I think that is also the reason why we are fastly catching up with the leading companies in the world. So I'm sure that there are a lot of participants who want to stay with us and trying to have a better and shared future for the cooperation in the AI economy.
Okay, Dr. Zhou, of course, always great to have your thoughts. Dr. Zhou Mi, Senior Research Fellow at the Chinese Academy of International Trade and Economic Cooperation. Well, AI is indeed transforming businesses, but not without a cost. The heavy use of AI chatbots and tools has given rise to a new concept known as token maxing. Now, if that term is new to you, don't worry. Our reporter Mark New is here to break it all down.
When AI reads a prompt, roughly every 4 characters equals a token. Earlier this year, how many tokens an AI tech worker used became a sign of productivity, with companies encouraging maximum usage, which came to be known as token maxing. Companies such as Meta and Amazon even used leaderboards to reward workers who used the most tokens.
But there's a dark side of that. Nothing is free. The more token you are using, the more money you're going to pay.
We've heard that many companies are already blowing through their annual token budget.
Finance departments stepped in, forcing companies to slash AI budgets and shift policies toward token minimizing or token minning. But that opened the door for Chinese AI models, such as Z.AI's GLM, Alibaba's Qwen, and Moonshot's Kimi to move in at a lower price.
The reason for the Chinese models to be cheap is multiple factors. Number one, they are open source. Basic open source means what? Means the code is there, you can download it, you can check it. Now you have hundreds of thousands of engineers, software engineers, that help in the company for free. The other thing is they found a way to program better.
Banafa asked both Kimi and ChatGPT who won the World Cup and why. ChatGPT's answer is far more detailed, but he says Kimi's answer is simpler and more straightforward, sometimes all that's really needed. He asked both chatbots to compare the token prices of the leading U.S. AI models compared to Chinese models.
OpenAI, $35, Kimi, $18, Claude, $12, Gemini, $14, and Minimax from China, $1.55.
Yes.
Wow, that's way lower.
Yeah.
Lower prices have led U.S. companies like Airbnb and Amazon to incorporate Alibaba's Qwen, while cryptocurrency exchange Coinbase says it switched to Kimi and GLM to help it cut AI spending in half.
The future I see for AI, it should not be measured by how many tokens you have. It should be measured how smart that question itself. I envision that we're going to get to an area of the AI where the system will tell you there is another way for you to ask this question. Instead of relying on the human to squeeze their brain, there is a step saying, this is not the right way to ask that question. You can ask it this way. This is how much it's going to save you.
Banafa says the problem with that is that AI companies may have little incentive to help users spend less per prompt, since ultimately that could mean less money for them. Mark New, CGTN, San Francisco.
And that's going to wrap up this edition of Global Business here on CGTN. I'm Michael Wong here in Beijing. We'll see you again next time.